Investing can be a great way to grow your wealth and achieve financial freedom. However, it's important to approach investing with caution, especially if you're a beginner. There are many common investing mistakes that people make, and these mistakes can be costly in the long run. In this video, we'll discuss the top 10 investing mistakes that beginners should avoid.
Let me give you a figure that'll blow your mind, I think. I bought my first stock when I was 11 years old. It was the first quarter of 1942. I spent $114.75. Three shares, $114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today. Oh man, $400,000 today in one person's lifetime. Now, the market's gone down many times during that time. People have panicked during that time. Headlines have been terrible. But if you buy it for 10, 20, just keep buying the S&P 500 index and forget about all the other nonsense that's being sold to you.
Investing without a plan. One of the biggest mistakes that beginners make is investing without a plan. Before you start investing, you need to have a clear idea of your investment goals and the strategies you'll use to achieve them. Without a plan, you're likely to make impulsive decisions that can lead to losses.
The question is about diversification, and I've got a dual answer to that. If you are not a professional investor, if your goal is not to manage money in such a way as to get a significantly better return than the world, then I believe in extreme diversification. I mean, so I believe 98 or 99%, maybe more than 99% of people who invest should extensively diversify and not trade. So that leads them to an index fund type of decision with very low costs. Because all they're going to do is own a part of America. And they made a decision that owning a part of America is worthwhile. I don't quarrel with that at all. That is the way they should approach it.
Not diversifying your portfolio. Another mistake that beginners make is not diversifying their portfolio. Investing all your money in one stock or asset class is risky because if that investment performs poorly, you'll lose a significant amount of money. Diversifying your portfolio can help minimize your risk and maximize your returns.
Never chase the hot thing, whatever it is. That's like trying to catch the wave, and you'll never catch it. You need to position yourself and wait for the wave.
Chasing hot stocks. Many beginners make the mistake of investing in hot stocks or trends without doing their research. This can be a costly mistake because these stocks are often overpriced and don't have a solid foundation. Instead, focus on investing in companies that have a strong track record and a solid business model.
The interesting thing is, obviously, we haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have had. We have never made, Charlie and I don't think, in all the time we've worked together, and I'll tell you something later on maybe about how learning takes place, but I don't think we've ever made a decision where either one of us has either said or been thinking we should buy or sell based on what the market is going to do.
No.
Or for that matter, on what the economy is going to do. We don't know. And the interesting thing is, sometimes I get some credit someplace for the fact that, how wonderful it was that we were optimistic in 2008 and when everybody was down on stocks and all that sort of thing.
Timing the market. Timing the market is another mistake that beginners make. It's impossible to predict when the market will go up or down, and trying to do so can lead to missed opportunities and losses. Instead, focus on a long-term investment strategy and stick to it. Overreacting to news. It's common for beginners to overreact to news and headlines about the stock market. However, short-term news and events rarely have a significant impact on the long-term performance of the market. Instead, focus on the fundamentals of the companies you're investing in.
If I said to you, Brandon, here's the deal. I want you to make an investment with me. Here's how it's going to work. I want you to give me your money. You're going to put up all the money. You're going to take all the risks. If it loses money, if it loses everything, you lose everything.
There's no consequence here.
Yeah, no. You put up all the money, take all the risk, you take all the losses. But if you make money, and even if you don't make money, I get paid.
Right.
And I get, over the course of your lifetime of investing, 30, 40 years, I'm going to take 60%. Would you make that deal?
Nobody would. but they don't know that they are all day long. You know
That's right. And that is what you do with the average mutual fund today. Because the average mutual fund with Forbes is 3.1%. If you're in a 401k, instead of saving money, many times when you add all the other fees, according to Forbes, it's 4.1%. What that does to your ability to ever get financially free is it basically decimates it. And how's that possible? Jack Bogle, head of Vanguard, taught me this. He said, Tony, watch. Because people don't know. They don't do the math. For every 1% you give away over the course of your lifetime, that's approximately 20% of your total take.
Ignoring fees and expenses. Many beginners don't pay attention to the fees and expenses associated with investing. These fees can eat into your returns and significantly impact your investment performance over time. Before you start investing, make sure you understand the fees and expenses associated with your investment accounts. Being too conservative. While being conservative can be a good thing when it comes to investing, being too conservative can also be a mistake. If you're too risk-averse, you may miss out on opportunities to grow your wealth. It's important to strike a balance between risk and reward when investing.
Well, we make bad investment decisions plenty of times. I make more than Charlie because I like to think it's because I make more decisions, but probably my batting average is worse. But I can't recall any time in the history of Berkshire that we made an emotional decision. That I know the movie had Jamie Lee in there, but that was for laughs. But have we ever made an emotional decision?
No.
No. That's in business we're talking about. Yeah. No, you don't want to be a no emotion person in all of your life, but you definitely want to be a no emotion person in making an investment or business decision.
Investing based on emotions. Investing based on emotions is another mistake that beginners make. It's easy to get caught up in the hype or panic of the stock market, but making decisions based on emotions can lead to poor investment choices. Instead, focus on a rational, data-driven approach to investing. Not rebalancing your portfolio. Another mistake that beginners make is not rebalancing their portfolio. Over time, the asset allocation of your portfolio can shift, which can impact your risk and returns. It's important to regularly rebalance your portfolio to ensure that it aligns with your investment goals and risk tolerance.
I was just wondering, what would you consider to be the worst investment you've ever made?
The worst investment I ever made? The biggest mistakes are the ones that actually don't show up. They're the mistakes of omission rather than commission. We've never lost that much money on any one investment, but it's the things that I knew enough to do that I didn't do. We have missed profits of as much as, maybe $10 billion in things that I knew enough to do and I didn't do it.
Not learning from your mistakes. Finally, one of the biggest mistakes that beginners make is not learning from their mistakes. Investing is a learning process, and everyone makes mistakes along the way. It's important to reflect on your investment decisions and learn from your successes and failures. Conclusion: investing can be a great way to achieve financial freedom, but it's important to approach it with caution. By avoiding these common investing mistakes, beginners can maximize their returns and minimize their risk. Remember to have a plan. Want to show off your passion for entrepreneurship and investing? Check out Invest Avenue, the ultimate destination for stylish clothing and accessories. Explore our collection of t-shirts, sweatshirts, caps, glasses, and more, all featuring unique prints related to investing in business. Visit our store link description to support the channel and represent the Invest Avenue brand. Start dressing like a successful entrepreneur today.